Hey, Dan Passarelli here. How are you feeling today? Oh man, we've got something great to talk about today. We're talking about a system that we created at Market Taker called the Red Knockout and how to unlock momentum for big gains using it. Now, first, I want to make sure you can hear me. If you can, please go to the chat box and type in yes. Let me know you can hear me. Go to the chat box. I don't think there's a questions box today. I think it's just a chat box. So go to that chat box and tell me yes. That'll let me know that you can hear me. Yes? Maybe you're not able to. Or the Q&A box. Maybe you can't access the chat box. Hit the Q&A box for me, will you? Tell me yes if you can hear me. Ah, there we go. Excellent. Thanks, Thomas and Chris and Kevin and Robert and Gerald and Pablo and Deja and NTIS and Anne Marie. You guys are all great. I'll make sure that I ask for the questions box going forward here because I think you guys cannot see the chat box. That's okay. We'll be able to live that way, I think. All right. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. And don't trade with money you're not prepared to lose. Also, everything we're talking about today is generalized information. Without knowing your personal situation, I can't give you advice or recommend anything. Talk to a personal broker or advisor for that information. Now, I just read some names of some folks who are regulars here. You're part of the Market Taker family already. But I read some new names too. So allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the top option trading books, as well as many articles and lots of stuff, blog posts. I'm a trader. I was a professional trader for a long time on the floor of the Chicago Board Options Exchange, Chicago Board of Trade, CME Group. Now I trade in a retail account, just like you. And I am the founder and still president of Market Taker Mentoring, which is the global leader in option trader education. And I collaborate with a lot of good people in the trading industry, from exchanges literally all over the world to the best brokerage firms that allow for option trading, like Firstrade here. And outside of option trading, the important stuff, I'm a family man. My family's the most important thing to me. I got my wife, Kathleen, who many of you know, and my two adult children, Sam and Isabel, and a couple of cute little dogs too, a Yorkie and a Morkie. And on top of that, I do some other things outside of trading. I'm a runner. I am a foodie, traveler. Me and my family been all over the world together, travel quite a bit globally for Market Taker as well, and a musician, like listening music, playing it, and all that. Now, I've got a gift for you. We are going to talk about the Red Knockout, and this is, man, it is my number one just knockout punch momentum trading strategy. So I have written a strategy guide, like an ebook on it, and I want you to have it. And you can get that by going to markettaker.com/big mo, as in big momentum. Market as in stock market, taker as in take what is rightfully yours, 2 T's in a row. Markettaker.com/big mo, as in big momentum. All right. So the red knockout is pretty simple. And by the time we're done with our time today, you are going to understand what it is, how to spot it on a chart, how to trade it, and how to manage the trade and set your profit targets. Man, we're covering quite a bit today here. All right. Now, first, let's start out by listing the steps in the red knockout, and then we'll zoom in and go through some examples. Sound like a pretty fair deal? So step one is what we call the setup candles. And that's 3 or more green up-day candles that make up what we call the green run. We can call them the setup candles, or we can call them the green run. And then if the pattern continues playing out, we're going to get the red knockout candle, or the RKO, that eponymous candle that makes up sort of the crux of the system. And it's an important one. It is a red candle with a smaller body than the 3 preceding green candles. Next, if the pattern is indeed still playing out, we're going to get what we call the trigger candle. And that is a green candle that immediately follows the red knockout, that takes out the red candle's high, ideally on higher trading volume. And then finally, we have the confirmation candle. And if we have the confirmation candle, we have the red knockout setup. And confirmation candle is a candle that opens above the high of the RKO candle. And we get that. That signals trade entry. And it's 1, 2, 3, go. All right. Let's break this strategy down step by step and go through how it works. Step one is the setup candles, also known as the green run, correct? So you log into your Firstrade account, you pull up a chart, and if you see 3 green consecutive up-day candles, the RKO might be materializing. Now, what do I mean? What's the difference? I'm saying green up-day candles. Isn't a green candle an up-day candle? Well, no, not necessarily. A green candle is up from today's open. An up-day candle is up from yesterday's close. So this candle here, it opened here and it closed here. Now, how do I know that? How do I know it didn't open here and close here? Because if it's green, it's up from the open. So the body, the bottom of the body is the open, the top of the body is the close. Whereas this red candle here, because it's red, we know that the top of the body was the open and the bottom of the body was the closed. And of course, the wicks are just, this is the high and this is the low. Now, this candle is also an up-day because yesterday, well, this red candle closed here, right? So it's up from yesterday's close and it's up from the open. And so is the next one, up from the open, up from yesterday's close. And so is the next one, up from the open, up from yesterday's close. And so is the next one. Up from the open, up from yesterday's close. Now we need 3 of those. In this case, we have 4. The more, the merrier. Now, do you remember what comes next after the green run? Do you remember? Well, I'm going to tell you. The red knockout candle, or the RKO candle. Now, what is the red knockout candle? It's a red candle immediately following the green run that has a smaller body than each of the 3 most previous green candles. If it's bigger than the 4th one or 5th one or 6th one, that's fine. So that's what we have here. The body, not the wicks, but the body is smaller than this one, smaller than this one, smaller than this one. The wicks don't matter. Note also, it doesn't matter if it opens up or down from yesterday's close. In fact, this one opened higher than yesterday's close. And at some point in the day went pretty high, but then pulled back to close down on the day and down from yesterday's close. It doesn't have to close down from yesterday's close, but in this case it does. Now you might never see one of these candles, or it might have a really big red body and we don't care about it. But if you see one of those red candles, and if the body's smaller than the 3 preceding green candles, then the pattern is still playing out. Still no action yet, but it's still playing out. When we get to the trigger candle, now the rubber is starting to hit the road. Now we've kind of got something here. This is a green candle that takes out the high of the RKO candle. Now, what does that mean? Takes out the high. What does that even mean, right? I'm going to tell you what that means. This candle can open higher. It can open lower. Doesn't matter. It could open down here. As long as A, it's green, and B, it trades above the highest point of the red candle. If it does, we're calling that a trigger candle. And I call it the trigger candle because it's kind of like, I've never been in a shooting competition or anything, but like, I kind of know how it works. Like when they're like, okay, get ready. Do they say ready, aim, fire at these things? I don't really know. But like the marksman is like ready to, fire at the target, gets the finger on the trigger and is just ready. Doesn't shoot yet, but is ready. And then we wait for confirmation. And if we get confirmation, bingo, that's what we get. Now the confirmation candle opens above the high of the RKO candle. And that's the only criterion. It opens above the high of the RKO candle. And if it does, it's fire on the target. We're ready to go. Catherine is back. Hey, Catherine, I missed you. How are you? I hope you're doing great. Catherine says, does the trigger candle have to close above the high of the RKO candle? Or is it enough if the wick is above? Great question. You're paying attention. It does not have to close above the high of the RKO candle. And Catherine is talking about this one, trigger candle. Sometimes the trigger candle can be a red candle, actually. Or no. It can't be a red candle. But it doesn't have to close above the high of the RKO. Like if this body was lower and the top of the body was like here, still a trigger candle. Still a trigger candle. Very good question. You're paying attention. I love that. You're always paying attention. You're studious. Okay. So the confirmation candle opens above the high of the RKO and signals trade entry. Now this one can actually pull back. It can actually end up red. The only criterion is it opens above the high. So let's expound upon this. We're going to go through a realistic scenario. If we have a red knockout setup, what is the first thing we look for? Who's paying attention over here? I know Catherine is already. I don't even have to ask Catherine. What is the first thing we look for if we end up identifying a red knockout? The setup candles, right? 3 or more green upday candles in a row. Do you see that on the chart anywhere? I do. I see it on the chart a couple of places. The one where it actually ends up playing out as a complete RKO setup is it starts here and it ends here. Now this one, oh, you know, every once in a while on charts, you end up getting goofy data. And as you see on this day with this little tiny thing here, there's no volume. So this actually is a bigger candle, but it's just sometimes charts get goofed up. So I wanted to call that to your attention so you don't say, wait a minute, the red candle's got a bigger body than this one. It's just a goofed up candle. That's all. So we've got this one, and then we've got this one, then we've got this one, and then we've got this one. This is a 4 candle setup. So that is the green run, and it establishes that the trade might be setting up. Okay, are you getting this? You know, we're not making any trades yet. We got to wait to see if other things play out. Now, what is step 2? Do you remember what step 2 is? The red knockout candle. The red knockout candle of the RKO. If a red knockout candle shows up on the chart, it's very easy to identify. And it means that the setup might be materializing. The RKO is a fairly small bodied candle if it's an actual RKO. Smaller than each of the 3 green setup candles. So again, this one's just goofed up, but trust me, it's bigger. So it's just got to be bigger than this one, and this one. Doesn't matter if it's bigger than this one. Now, the key is that it's down from the open, which is what a red candle means. It actually opened higher than the previous day, started out as an update. In fact, it actually closed as an update. It closed at a higher price than yesterday's candle. But it is still a red knockout because it's red and it's down on the day. Now, you might be wondering, Dan, what is the significance about this? Why does it matter? Why does it matter if it's a red candle? Well, because this is a momentum-based strategy. And one of the things that I've studied and I still trade, I use to trade momentum and even some other strategies is something called RSI. If you're taking notes, write that down. RSI. That is the relative strength index. And truth be told, it's one of the things that I use in conjunction with the RKO. And the reason why they kind of go a little bit hand in hand is because with any momentum trade, what happens is you start getting some momentum. It starts going up, and it starts going up, and it starts going up, and it starts going up. And if it just keeps going up powerfully, 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 then at some point it burns itself out and the rally ends. So what do we need for the rally to not end? Well, we need a pullback, right? And if it's a big major pullback, well, by definition, the rally's over. So we need a little bit of a pullback that's just enough to let people who didn't get in on the first 3 or 4 or 5 candles, which are daily candles in this case. This actually works on all time frames, but I typically look at it on daily candles. And it gives people a chance who missed the first part of the move to get into it. Okay? It shows a little bit of weakness, gets the price a little bit lower from the open that day so that people do decide to buy. And it goes against the RSI so that the RSI doesn't bust through the 70 line and end up being in overbought territory. Because once it crosses back down below the overbought territory, that's when people tend to start selling. So it's pretty important. And you kind of look at that red candle as like the middle of a teeter-totter, a fulcrum. Remember doing like physics projects when you were a kid? Fulcrum. That's that fancy word that like you were all like thinking of yourself like, oh yeah, I know fancy words. I bet my parents don't even know that word fulcrum, even though they probably did. But it's just, the middle of the teeter-totter here, right? Because what we're really looking for is if this keeps pulling out up, we're looking for a repeat of that green run above the RKO candle. That's why I say it's kind of the fulcrum, the middle of it. Okay, so what's step 3? Do you remember what is step 3? Step 3 is the trigger candle, which I designate by a yellow arrow. Now that triggers that the trade is indeed setting up and you're getting ready to time your entry. Marksman's got his finger on the trigger. He's not ready to fire just yet upon the target, but he's ready. It's the trigger candle. So then, finally, if the trade completely sets up, like if we don't get a confirmation candle, I don't make a trade. But if we do, then this is the confirmation candle, which is step 4, the final one. And that means the trade is confirmed. The setup is confirmed. It's got a green arrow under it. And green means go, fire away. Boom, right? Easy enough. Okay. So let's slow this down a little bit. I've already gone through the roles of each of the 4 components of this somewhat, but let me break it down even more. I want you, like, here's my, I want you to leave here really, really being good at this and being able to spot these and being able to trade them. Oh, hey, Pablo asked a question here earlier. Why can you choose what time frame to work with? Slideshow was hourly. This looks like daily. All of the ones in my example are daily candles. Every example I'm using are daily candles, but this setup does indeed work on all time frames. I just saw one this morning on the minute charts. You'll see them on weekly candles, monthly candles. This works for day traders as well as long-term investors, Pablo. Eric, what stock ticker is being used in this example? Man, I forget. I honestly forget. And also, a lot of times the compliance department at brokerage firms don't like you talking about specific stocks because, like I said in the beginning of this, I'm not making recommendations. Like I'm really literally not. What I'm trying to do is to train you to be able to spot these, to empower you so that you can trade these for yourself. So in that regard, it doesn't really matter what underlying stock it was. Okay. So we've got the green run here. 1, 2, 3, 4. Coincidence. All these examples here happen to have 4 so far. Actually, I think I'm reusing this one from the last one, if I'm not mistaken. 1, 2, 3, 4. And we get this upward momentum. So if you look on the RSI, which I didn't list out here, you'd be seeing the relative strength increasing. But the problem always is when the relative strength gets too high and crosses above the 70 line, it only goes to 100 and comes back down, party's over. So after this mini trend, or first half of the trend, we finally get our little baby pullback. This is our eponymous red knockout candle. Mini trend, opened higher, doesn't matter if it opened higher, could have opened lower. And it's on low volume too, which is kind of nice as well, because volume means conviction. The less volume there is, the less, people really think the sell-off should have happened. Whereas even though we're missing some volume on this day, we got volume increasing. Then, oh, it's down, but people don't really care that it's down. But then, boom, the next day, volume's increasing. Takes out the high of the RKO. And why does that matter? Because we've got to see a sign that the trend is actually still continuing, that it's actually going up. Because otherwise, this red candle could just be the first candle in a turn down, like it is here. Like here's a red candle. Is on low volume, but it's got a bigger body. It moved down quite a bit more, and it ended up being followed by another red candle. Like party ended here, but it didn't here. Just a little blip on the radar. This is okay. Game back on. This is like when you're playing street hockey as a kid, and you got the net set up in the middle of the street, and you're playing, and then it's like, wait, car, and everybody stops the game. This is what the red candle is. Everybody stops the game. They move the goals out of the street, let the car go by, and then, oh, trigger candle, game on. Okay, put the nets back in the street. Let's play street hockey again. Okay. The final step, if this does indeed set up, all this has to do is open above the high of the red candle. What is possible when this sets up nicely? Well, this one had like a nice big candle on confirmation day. So what we do is we tend to get into the trade on confirmation day. Once it's confirmed, once it opens above the high of the red candle, it's confirmed. So in our course, we have Market Taker has a whole course on this. We teach to get in at the beginning of the day on the confirmation candle. Why? Well, because although the confirmation candle could be red, it could actually end up lower on the day, and that's okay. You just take a little bit of heat, if you will, and you might get stopped out. You'll get stopped out sometimes. But if it pulls back a little bit after the open, that's okay. But it's my observation, anecdotally anyway, that you tend to see a green candle this day. You tend to see that candle going up. Not always, but you tend to. So I always like to get in on the open on this day. Could have, I mean, look, man, could have got in below 21 and closed out on the same day. That's 50 cents. That's not a whole ton. I mean, it's 0.25%, I guess, right? No, it's a little over 2%, right? Yeah, a little over 2%, 2.25%. But if you're using options, you get that leverage. So you're probably wondering about getting out. And I'm going to talk about the price targets in a minute. Peter says, is there an automated way to spot these situations, or do you have to constantly comb through chart data? Well, we do. Listen, grab this ebook / strategy guide. Go to markettaker.com/Big Mo. Grab this ebook. And when you get that, there's more information in there than I cover here. And you're going to end up getting an email, and it talks about how we can automate it. In fact, there's even a replay to a webinar that's more elaborate than this. So make sure you get that ebook, markettaker.com/Big Mo. Anonymous says, what's the name of that whole setup? I'm trying to download that study on Thinkorswim. You can't download it on Thinkorswim, but if you grab that ebook and attend the and watch the webinar, I'll just, steal my own thunder here, cut to the chase. There's a link at the end where we offer the Thinkorswim study, and there's other ways to use it. You don't necessarily have to use Thinkorswim or anything, but yeah, you can do that. So, but definitely grab the ebook, markettaker.com/Big Mo. Okay, a couple more things here to talk about. Another example. And I'm going to make this kind of more real life. The other ones were pretty zoomed in. The other ones were pretty zoomed in. This is not zoomed in. This is what you would probably be looking at if you tend to look at 6-month charts, which I do. These are daily candles on a 6-month time frame. Do you see it here? Now you really got to train your eye. You really got to train your eye. Do you see it? Well, how about starts there, ends there? We've got 1, 2, 3, 4, 5 setup candles this time. All we really need is 3, just 5 setup candles. Okay. And do we see here we had 4, but this was a down day. Yeah, we really don't see that anywhere else on this chart. Well, here was 3, but then the red candle was a bigger body, and this one didn't take out the high. Yeah, this is the only place on the chart that we see this anywhere. So it continues on. Bammo, there is our red candle, our RKO candle. There is our trigger candle, traded above the high of the red candle. There's our confirmation candle, opened above the high of the red candle. And there we go. Now, if we follow our profit-taking rules, we would get out once it gets up to here, which is, in this case, right around $19.19. So we get in 18 and change, get out at 19.19, which in this case would have been the next day, which is nice. And some of the previous examples, we probably had to wait, like on this example, we probably would have had to wait until this day, which was 1, 2, 3, 4, 5 days later. These tend to be anywhere from, I mean, every once in a while you get out the same day. But usually they go from like a 1-day trade to like even up to a 2-week trade. You just got to wait until it hits that profit target. So you're probably wondering about profit targets. I'm going to talk about them, but first, my friend Peter has a question. Peter says, does volume come into play here? The strategy seems to be limited only to price action with no consideration of volume. It does come into play. It comes into play on, hold on a second here. Let me go back to this first definition. The trigger candle is a green candle that takes out the high of the red candle's high on higher volume. So that's really the only place that it comes into play, is on that trigger candle, because we need to see renewed momentum. We need to see renewed momentum. Is it actually going higher? Yes. And there's conviction to it. That's the only place it really matters. Now, oh, actually, hold on one second here. Hold on one second here. Okay. So let's talk about how do we set those price targets. The price target is a percent of the green run. Remember I described the RKO candle as the fulcrum, the middle of the teeter-totter. This part of the teeter-totter, we want to see play out after the middle of the teeter-totter. If it ran up $2 after the red candle, we want to see it run up $2. But do we want to be greedy? Well, we're traders, maybe a little bit, but you know, what is this saying? Bulls make money, bears make money, pigs get slaughtered, right? We don't want to be too greedy. We want to lock in winners. We want to manage our risk and lock in winners. So here's what we're going to do. We're going to take the low of the first green setup candle and subtract that from the high of the last green setup candle. And then we're going to multiply that sum by a haircut. That is a percentage. Typically, we use less than 100 to be more conservative. Anywhere from 70 to 90%. So if it ran up $10, okay? If we use a 80% haircut, we're not going to look for another $10 rise after the RKO. We're just going to look for 80% of a $10 rise, an 80% rise. All right. So we're going to take that haircutted sum of the green run and add that to the high of the RKO candle. And that's going to be our profit target. And then if we're buying the stock or if we're buying a call, we're going to use a stop loss. If we're trading a spread, we do it differently. We set an alert. All right. So let's examine how this might work. What is our first step? Do you remember in setting the profit target? I know you already know and got down pat how to identify this setup. To set up the profit target, we take the high of the green run minus the low of the green run. Okay. So the high here is $20.87. That's actually right here. And we subtract from that the low of the green run here. So that's $20.87 minus $19.70. And we're going to multiply that times the haircut. Now, this is a lower price stock. So that enables us to, stocks move in percentages. That right there is a $1.17 move, which is like 5% in 4 days. So that's actually a pretty big move. You buy 100 shares at $20 or whatever, and it costs you $2,000. So if you have a small account, maybe you buy 100 shares, or maybe you buy a call that has more leverage. If you have a bigger account, some people with bigger accounts might buy 500 shares or 1,000 shares. Or they might buy more than one call, 5 or 10 or 20. This all scales to your account size. But what matters here is we're looking for this run from the low here to the high here to repeat after here. But the piggies get slaughtered, right? So we don't want to be too big of a piggy. We're not going to wait for that whole move to play out. We're going to wait for, in this case, 90% of it play out. We're going to multiply $1.17 times 90%, which is 0.90. So that comes out to $1.05. So we are trying to capture the run-up of $1.05 above the high of the red run, which is $20.83. When the stock hits $20, $20? No, $21. Hold on a second. Oh, yeah, I see. No, I had that right. When the stock hits $21, yeah, the high of the RKO is $20.83. So $1.05. Okay, so again, the green run, $20.87 minus the low of it, 1970, is $1.17. We're going to haircut that. Take 90% of that as $1.05. We're going to add that $1.05 to the high of the RKO, which is $20.83. So our target is set at $21.88. That's like right about here. So actually, in this case, it does actually trigger the next day, which is nice. If it didn't, we'd almost have hit it here. We wouldn't have. We almost would have, but we'd have creamed it here. So this opens down on the day, or no, almost unchanged on the day here, but it's up, takes out the high. And here it opens pretty much unchanged from that day. We get in this day and we get to capture from probably get in around 2090 or something. We make about $1. Oh no, actually we get out. Yeah, we make probably about $1 on this, about 5%. Pablo says, if we're using options, are we looking to buy in the money options? Yeah, my guidance, again, like it's all really in the class, but my guidance is you want anywhere from a 70 to a 35 delta option. So we could go in the money could go out of the money. I give that really broad range because sometimes there's not that many strikes. You know, like Apple, there's strikes every dollar. SPY, same thing. But, you know, there's some stocks where there might be strikes every $5. So there's not that many delta options to choose from. So, yeah, I typically, oh, and the expiration to use is the monthly expiration because it tends to have the most liquidity, the tightest bid-ask spreads, as long as it has more than 10 days. Okay. Good questions. Pablo is paying attention. All right. So, man, easy to find the setup, easy to calculate the exit. Where do we use this? Well, it can be traded on all time frames. 1 minute candles, 15-minute candles, 4-hour candles, daily candles, weekly candles, even monthly candles. Good for day traders, good for investors. And it can be traded really on any asset class. I personally trade them on stocks and ETFs, but they can be used on futures, on currencies, anything that's chartable. A couple of screening tips. We want to avoid earnings. If earnings is coming out, we're going to skip this. This is a great tip. If you are taking notes, please write this down right now. It works best if the pattern goes through a key moving average, which is the 20-day, 50-day, or 200-day moving average. Even if I'm trading daily candles, I'm still going to use the 20-day, even though, or 200-day. I'm never going to hold this for 200 trading days. That's almost a year. But that's such a key pivot point that if it busts through that point, it'll tends to give it more buoyancy, more momentum. The RKO works best in up markets intuitively. If the S&P 500 is going up, like all stocks have a beta. If the S&P 500 is going up, well, most stocks are also going up. So that gives it extra buoyancy, extra momentum. Now you might think, but Dan, markets don't always go up. This must stink in down markets. Well, this does, but guess what? Its cousin, the GKO, which is just the opposite, works in down markets. And that's what I use in down markets. All right. What other questions can I answer before we call it a day here? What questions can I answer on the RKO strategy before we call it a day? Nothing? All right. Well, we are back next week. And we're going to be talking about how to election proof your stocks with puts. Now, that's going to be an interesting one. It's probably not as straightforward as you think. There's a lot to that. Is there a screening tool that we can use to find these momentum stocks? Yeah, again, Paolo, if you go to markettaker.com/bigmo and you download this ebook, it'll automatically trigger a couple of emails to you where you'll be able to get a screening tool. At what price should I sell it? Well, I just went through that way to calculate it. The price target. That's what all this math was. That's why we spent, some time on this. You subtract the low here from the high here, multiply that times the haircut, in this case 90%. Add that to so that's $1.05. Add that to the high of the RKO, which is $20.83. So you should, if you're buying the stock, you would sell the stock at $21.88. If you're buying a call, you would sell the call when the stock gets to $21.88. Catherine, why doesn't everyone use that strategy? And if everyone starts, that'll spoil eventually. Well, you're right. People should use that strategy. And you're right. If everybody used the strategy, it will spoil eventually. But right now it's not spoiled. So it is not a crowded trade at this point. So grab my ebook. And it's usable. My question can be, are algos spoiling it already? No. Most of the algos out there are like high frequency trading and they're doing crazy stuff. They're trying to capture pennies millions and millions of times. And they're a little bit less worried about stuff like this. All right, folks, thanks for spending your time with me. I will see you a week from today on how to election proof your stocks with puts, but special way to do it for protection. And I'll see you then. This is Dan Passarelli, Trade Smart.